What if I told you that your money is capable of working harder than you ever could? That your savings could generate income even when you're asleep, on vacation, or spending time with your family? Imagine waking up each month to deposits hitting your account, not because you clocked in for more hours, but because your investments quietly paid you. Most people never experience this. They let their cash sit idle in a bank earning pennies, while inflation silently drains their wealth. But a small group of smart investors have unlocked a different path. A path where $100,000 isn't just savings, but the seed of a financial machine that pays them forever. They're not gambling on risky stocks, not chasing crypto pumps, and not trying to time the market. Instead, they're using a simple set of high-yield dividend ETFs, SCHD, JEPI, VGT, CDL, to turn ordinary savings into extraordinary passive income. And today you're about to see exactly how that strategy works, why it's so powerful, and how it can transform your financial life faster than you think. Because once you discover how to turn $100,000 into a growing stream of cash flow, you'll never look at money the same way again.
Welcome to WealthEchelon, your go-to spot for smart investing, in-depth ETF insights, and book reviews that help you build wealth. On this channel, we explore everything from the best investment strategies to the latest trends in ETFs and provide valuable takeaways from books that can transform your financial journey. Whether you're a beginner or an experienced investor, our goal is to give you the knowledge you need to make informed decisions and grow your wealth. If you're ready to elevate your financial game, hit that subscribe button and don't forget to turn on the bell for updates on all our latest content. Most people believe building wealth requires working harder, longer hours, multiple jobs, endless stress, and constant sacrifice. But the truth is far simpler. Wealth doesn't come from working more. It comes from owning assets that work for you. And one of the most powerful, reliable, and beginner-friendly strategies to achieve this is dividend investing. Today, we're breaking down how turning $100,000 into a monthly passive income machine is not only realistic, but something thousands of smart investors are already doing using high-yield dividend ETFs. This video isn't about risky stock picking or unrealistic promises. It's about understanding how money grows when it's placed in the right investment vehicles, and how those investments continue paying you even when you're not working. What most people don't realize is that cash sitting in a bank account is slowly losing value every single year. Even with so-called high-yield savings accounts, your money might earn 1 to 2% if you're lucky, while inflation quietly eats away 3 to 5% of your purchasing power. That means your savings feel safe, but in reality, they're shrinking. Investors who understand this shift their mindset from saving to owning, specifically owning income-generating assets. And one of the best tools for this is a well-diversified dividend ETF portfolio. Instead of relying on a single company or stock, dividend ETFs spread your investment across dozens or even hundreds of strong, stable companies that pay you a portion of their profits every quarter. This is where dividend ETFs shine. They convert your savings into a reliable stream of passive income. With $100,000 invested in the right mix of dividend-focused ETFs, it's completely possible to generate $350 to $450 every month in passive income without touching the principal. That's money that arrives automatically, every quarter, whether you work or not. And unlike a job, where you must trade hours for income, dividends are truly passive. Your portfolio doesn't take vacations, doesn't get sick, and doesn't slow down. It keeps paying and growing, day after day. What makes this strategy even more powerful is that many dividend ETFs increase their payouts every year. That means your income today is only the beginning. Over time, it compounds into something much larger. A popular foundational ETF for income seekers is SCHD, also known as the Schwab U.S. Dividend Equity ETF. SCHD focuses on high-quality, financially strong companies with a long track record of paying and growing dividends. With a yield typically around 3 to 4%, SCHD provides both income and long-term growth. It's not just a dividend ETF, but a total return powerhouse. Over the past decade, SCHD has beaten many active funds simply by sticking to its disciplined methodology, selecting companies with consistent cash flow, strong balance sheets, and rising dividend histories. For someone investing $100,000, SCHD alone can generate around $300 per month, depending on market conditions, and it's historically increased its dividend every year. Next, consider JEPI, the JP Morgan Equity Premium Income ETF. JEPI takes a different approach by using a covered call strategy, allowing it to generate higher monthly income. It's known for yields between 6% and 10%. Unlike SCHD, JEPI prioritizes income over maximum growth. This makes it ideal for investors who want stable cash flow today. While SCHD grows your dividend over time, JEPI makes sure you get paid more upfront. Combining the two creates a balance, growth plus higher income. Many dividend-focused investors use JEPI as their income engine and SCHD as their growth engine. But income investors don't stop there. To diversify further, high-growth ETFs like VGT, the Vanguard Information Technology ETF, play a major role. Although VGT isn't a high-yield dividend ETF, tech companies inside it drive long-term portfolio growth. Why does that matter? Because the key to secure future income is having a portion of your portfolio in fast-growing sectors. Tech companies reinvest profits instead of paying high dividends, but their share prices tend to grow much faster than traditional dividend companies. So even though VGT's yield is low, its growth helps increase your portfolio value, giving you more flexibility, more future income, and more financial security. Another powerful dividend ETF often added to the mix is CDL, which focuses on high-yield, value-oriented companies. CDL prioritizes companies with stable cash flow, strong fundamentals, and generous payouts. Its yield is usually higher than SCHD and complements ETFs like JEPI. By blending growth, stability, and high yield, an investor with $100,000 can create a diversified strategy that withstands market fluctuations while delivering consistent income. But here's where the true magic happens: reinvestment. When you're starting your financial freedom journey, reinvesting your dividends is the single most important habit you can develop. Instead of spending your dividends, you automatically buy more shares of each ETF. More shares mean more dividends mean more shares, and that cycle accelerates every quarter. This is what investors call the snowball effect, small at first, but unstoppable over time. Many people underestimate how quickly things grow when dividends are reinvested. A portfolio that begins generating $400 per month can easily grow to $600, then $800, and eventually far beyond, all without adding extra money. One of the biggest advantages of dividend ETFs is emotional stability. When markets crash, and they always do, investors holding individual stocks panic. They sell at the bottom and lose years of progress. But income-focused ETF investors behave differently. Why? Because the dividends keep coming, even in downturns. Rather than seeing red numbers on the screen and panicking, they see an opportunity. Cheaper share prices mean their reinvested dividends buy more shares. That's why dividend investors often perform better emotionally. They are not betting on price swings. They are collecting cash flow. This mindset shift turns volatility into opportunity. Building a dividend portfolio also offers something most jobs never do: freedom. When your assets generate income, your dependence on a job decreases. You're no longer trapped in the cycle of trading time for money. Even an extra $400 per month can change your life. It can cover groceries, utilities, transportation, phone bills, or insurance. And as the income grows, so does your flexibility. You can reduce work hours, decline stressful tasks, take more vacations, or save more aggressively. Dividend income doesn't just create money. It creates options. But reaching financial freedom doesn't happen by chance. It requires a clear strategy. That begins with choosing the right mix of ETFs based on your goals. Someone focused on higher income might lean more toward JEPI and CDL. Someone focused on growth might overweight SCHD and VGT. Someone who wants the perfect middle ground might use a balanced combination of all four. A sample allocation could look something like this: 40% SCHD for quality and dividend growth, 30% JEPI for higher monthly income, 20% VGT for long-term capital appreciation, and 10% CDL for additional yield diversification. This is just an example. The core idea is balancing income today with growth tomorrow. Another key principle is consistency. Once the portfolio is built, the next step is automation. Automatic reinvestment, automatic monthly contributions, even small amounts like $200 per month, and automatic discipline. Most successful investors don't check their portfolios every day. They set the system and let time do the heavy lifting. Meanwhile, the dividends continue flowing without any manual effort. That's what separates investors who succeed from those who quit early: the ability to stay invested during good times and bad.
It's also important to understand taxes. Dividend income can be taxable depending on where you live, but ETFs like SCHD benefit from qualified dividends, which are often taxed lower than regular income. And because ETFs distribute dividends from dozens of companies, they're more tax efficient than holding individual high-yield stocks. Many ETFs also have low turnover, which means lower capital gains taxes over time.
Fast forward a few years, and something incredible happens. That $100,000 portfolio is no longer worth $100,000. With growth, reinvestment, and compounding, it may grow to $130,000, $150,000, even $200,000, depending on contributions and market performance. And the income? What started as $400 per month can grow into $600, then $800, and eventually much more. At that point, you're no longer earning a return on your money. Your money is earning for you. This is the point when people realize they're no longer dependent on their job. They are free. Financial freedom doesn't require millions. It doesn't require luck. It doesn't require high-risk investments. It requires ownership of productive assets and a commitment to long-term thinking. Dividend ETFs offer one of the simplest, safest, and most scalable ways to turn savings into income that grows and supports you for the rest of your life. Whether you're starting with $100,000 or aiming to get there, the path is the same. Invest consistently, reinvest dividends, diversify smartly, stay patient, and let compounding work its magic. In the end, financial freedom isn't measured by how much money you have. It's measured by how much passive income your investments generate. Because a job can pay you once, but the right portfolio will pay you for the rest of your life. With the right dividend ETF strategy, $100,000 is more than just savings. It's the foundation of a lifelong income machine. Thanks for watching Wealth Echelon. We hope you found valuable insights that will help you on your investing journey. If you enjoy the video, make sure to hit the like button, subscribe, and turn on the notification bell so you never miss an update. Keep building your wealth, and we'll see you in the next video. Don't forget to check out our other videos for more investing tips, ETF strategies, and book reviews to continue growing your financial knowledge.